The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and welcome to another Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do within the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members. That's a great benefit, and we urge you to take advantage of that. Our AXA presenter today is Matt Rizzo from the Williamsville office. Before we get started, please note that the participants are muted during this session. However, we will save some time at the end of the presentation for Q&A. To ask a question, simply type your question in the Q&A panel on the box on the right on your control panel. And we'll be recording this session, and it will soon be available at saneys.org, where you will also find a list of AXA advisors in each region of the state. And with that, I'll turn the presentation over to Matt.
Thank you very much, Michelle. Good afternoon, everybody. My name, as Michelle says, Matthew J. Rizzo. I'm Vice President here at AXA Advisors. And thank you very much for taking the time out of your day, especially in the first week of school, to be on the call. And, the fact that we're here means that financial protection, or at least what we're talking about today, is somewhat important to you, or at least you're interested in learning a little bit more out about it. You work very hard, and if your family is like most families in the country today, probably you and your significant other, both work. And you depend on both incomes to pay ongoing expenses, put something aside for the future, etc. Maybe you want some ideas, some advice on, what you can do now, how you can improve your financial strategy to protect your family's financial independence. So naturally, you're interested in protecting the money you save and invest for things like college or retirement, or even later on. And typically, we start this presentation by just asking one simple question, not paying attention to all of that. And that's just, what is your most valuable asset? A lot of times people think maybe it's their home, maybe a car. A lot of the times maybe your investments, your stocks, your mutual funds, your 403b, especially in the New York State system. The answer a lot of the time might be, your pension. But really what we know is that the most valuable asset that you have is your earning power, your income over your working life, whether it be in your 20s, 30s, or even, in your 40s or 50s or 60s. The reason people often overlook their salary and their potential to earn more money is that you never get to see it all at once. It's not like an account balance in a monthly statement. So it's easy to forget just how much money we're talking about. The chart is a very simplified representation comparing a person's most important asset, the earnings over a 30-year period, and the value of the person's possessions and financial assets. So for the sake of clarity and presenting the concept, like I said, it's very simple. The chart is stripped of details like interest on investments, raises in salaries, taxes, and things like that. Not that those aren't important, especially coming from a financial advisor, but our purpose here is just to give you an idea of scale, the order of magnitude of the difference between what a working spouse earns over time and the value of what the family currently possesses. So as you can see, even a modest salary over 30 years adds up to quite a sizable amount. So when you're thinking about defining a financial protection strategy, you have to think about protecting this asset, the potential to earn. And now that we determine earning power is the most valuable asset, that sets our agenda really for the rest of the presentation. First, we'll look at what you can do to protect the most valuable asset, your potential to bring home a salary. Next, we'll present some survey data that shows what can happen when this asset isn't protected. And lastly, we'll look at what this all means for your family and what actions you can take today to help protect that most valuable asset. Many people equate protecting assets with an investment strategy. This slide lists some basic goals of a sound investment strategy. It's a plan, geared to minimizing risk and losses and maximizing the rate at which your assets can accumulate. So guarding against market volatility, to help guard against market volatility, it's wise to diversify your investments. Lowering tax liability, so the IRS can take, as we all know, a big bite out of, what we're making. So you should try as much as possible to take advantage of tax qualified accounts. In most of the people on this call's case, the 403b. And again, a lot of the times for the people that don't know, really the only difference between a 403b and the 401k is the 403b was available to a non-for-profit organization like a school district. A 401k is available to someone like myself that works for a for-profit organization like AXA. And then other things like a 529 plan where you get a state tax deduction for making contributions to that. And then again, offsetting the effect of inflation. So inflation's been relatively low lately, and people are kind of getting a little too used to it because it's below 3%. Historically, it's much higher. And, for example, in 1980, it was 13%. So to help offset the effects of inflation, especially looking toward retirement, more aggressive asset allocations are, again, using stock mutual funds inside of your 403b as opposed to bonds or guaranteed interest is a way to combat that. And it looks like a sound strategy, especially coming from someone like us that's our main role with a client. It is, but it's just not enough. And certainly no one denies the importance of implementing investment strategy more than us. You can and you should do as much as you can to safeguard your investments during, again, economic downturns in terms of financial uncertainty. But a smart investing strategy can only protect the assets that you already have. The best investment strategy in the world may not protect the most valuable asset, your earning power, the potential you have to bring in a salary year after year. And why is that? Financial uncertainty isn't the only thing that you have to worry about when it comes to protecting your family's assets. You have to deal with life's uncertainties, as we all know. Think back to the slide showing the value of the life's income. It was a big, big bar on the graph, but it took 30 years to accumulate it. What if you don't have the 30 years? What if you have much less time than that? And if you could be sure that you and your spouse would be there to work as long as your family needs the income, then there isn't a problem. And you could follow your investment strategy and potentially achieve your family's financial goals, but you can't be certain. And that's just what insurance is, no matter what type you're talking about. So basically, you have to plan for the things that no one wants to even think about. A lot of the conversations that we have with our clients, especially for myself that was born in a Sicilian household, I say God forbid about 37 times every single appointment. Because when you have to say, God forbid something happens to you, God forbid, you pass away, God forbid you get hit by the proverbial bus, so on and so forth, and my clients end up making fun of me because of how many times I have to say that. But it's just what you have to plan for. And if there's people who depend on you financially, you have to think about these things so that you can be prepared. You have to make plans to safeguard your family's financial well-being should any of these things happen. If you or your spouse die prematurely, if one of you become unable to work because of illness or accident, or later in life, if one of you lives with a chronic illness that requires substantial assistance. Those are things like long-term care assistance, nursing care, things like that. So you can't predict, you can't prevent, but you can plan, and you can provide protection, life insurance, disability income insurance, long-term care insurance. When a family's faced with premature death of a spouse, there's one financial product that can effectively help to safeguard it, and that's life insurance. And it brings us to our second topic of discussion today, which, it's unfortunate that many people have a limited view of the purpose of life insurance, and as a result, they overlook the role life insurance should play as an important part as the foundation of their overall financial strategy. And so I'll give you an example of when we do a comprehensive financial plan for a client. As Michelle had mentioned, typically that process is free for, educators and things like that because it's such a big part of our business. When we do this comprehensive financial plan, we show someone the distribution plan and, which options take in their pension and all of these different things. What we always say is, listen, this is all well and good, but God forbid you pass away or God forbid you can't earn this income in all of these years that we're showing you leading up to this. This isn't worth the paper that it's printed on. So one of the main strategies that we'll do is risk management to make sure that no matter what scenario plays out, that the goal is achieved in the end. So that's really one of the main purposes of life insurance. At death, income generally stops, right? So life insurance proceeds can replace the income that you're earning now, income that would pay for your family's day-to-day needs. And the time that it would take to earn income is no longer an issue because life insurance proceeds can help replace the income you would earn in the future as well. income that would fund investments, college funds, and retirement accounts. So you have to look beyond the death and the cost of dying, which is still very important, and look to the life of your family now and as they live on in the future. And so if you're putting money into mutual funds or a retirement account like a 403B or maybe a Roth IRA, which is a good strategy for people like yourself that have the New York State retirement system as a pension, because a lot of your assets are taxable. The pension is federally taxed, not state taxed. Social Security is taxed. What you take out of a 403B is federally taxed. There's a portion that is state tax-free, which is something that we can talk about. So a lot of the assets are taxable, which is why like something like a Roth IRA, which is tax-free income, is helpful as well. So any of those things that you're saving into, you don't have much money saved in it after 1 year, 2 year, even 5 or 10 years. With life insurance, premiums amount to a few pennies on the dollar when you're young and healthy. As long as premiums are paid, the full death benefit is paid immediately upon, God forbid someone passes away, or God forbid, if we're talking about disability income, when someone becomes disabled. And it's typically tax-free. One of the things that we'll talk about is when somebody has insurance through an employer like New York State, you get 3 times your annual salary, which when you get your retirement bulletin, it looks like a church bulletin every single year, and it's a different color, and it's a controller on the front page of it. It shows you what your death benefit is. Now, we like to call that as the worst buyout in the history of buyouts, because as everybody knows, if you pass away before you sign on the deadline for the pension's gone, and your family gets that death benefit. So yes, it's life insurance, but the way we look at it is it's the worst buyout any company could ever offer. And so when it comes to those 3 times your annual salary, the first $50,000 is tax-free, but then the rest of it is taxable. And the reason for that, or if anyone has a spouse that works for a private company, any insurance typically that a company offers you for free that you don't pay into is taxable, because they're getting the tax benefit by offering it to their employees. So with private life insurance, which is why it's so important, it's 100% tax-free. And then the money is there for your family to use for the present needs and the future plans. So when you focus on the future of your family, you can understand the need and the true value of life insurance protection. The consequences of not focusing on the future are illustrated in the next few things that we'll go through here. There's a lot of different studies, and it shows that underinsurance is a significant problem in the U.S. The easiest way to look at it is, nobody mandates that you have life insurance. Nobody mandates that you have disability insurance or long-term care insurance. But yet legally, we have to have car insurance. And legally, we have to have homeowners insurance. So if those things weren't mandated, then some people would have it and some people wouldn't, which is typically what happens with life insurance. But it's a little ridiculous when we think of it that way, that we have to insure a car and we have to insure our home, but we don't have to insure our lives or our families or our income. So the statistics that show are from LIMRA. And what it illustrates, unfortunately, is just a lack of awareness. So if you look at the second statistic, many people think their family's protected because they have life insurance at work. But we kind of discussed that typically in a private sector, it's at 1 times your salary, maybe 2 times your salary, and it's almost always going to be taxable in those situations. Through New York State, you get 3 times your annual salary, just to reiterate. First $50,000 is tax-free, the rest of it is taxable. The other thing to remember, coverage at work, a little bit different for people working in the school district, because typically, not always, but typically, if you're in the school district, you're going to work through New York State, through a specific school district until you retire. So because it comes through New York, you get to keep it. But for anyone that has a spouse in the private sector, I think the average now is people will change jobs 4 to 5 times in their life. Every time you switch a job or leave or retire, the group insurance goes away. So you have to hope either the new company offers at least better or, the type that you had. And so the slideshow the slide shows that the financial effect of a premature death on a spouse. So after the death of a spouse, expenses are likely to be about 80% about what they were before the spouse passed away. An easy way to look at that is, when you're grocery shopping, you're buying for 1 instead of 2. Not including kids, but again, gas, electric, you still have to pay your taxes, things like that. So there's a lot of expenses that don't change, and only enough to lower the expenses down about 20%. Income, though, so if our expenses go from 100% to 80% when one spouse passes away, typically a surviving spouse's income may only be 2/3 of what it was prior to the spouse's death, maybe half, maybe even worse. So now we've created a large financial burden. So the deceased spouse's pension is also impacted and can potentially leave the widow with as much as 50% of the total pension benefit. So again, just talking about the New York State benefit, we know how important that is as well. A rule of thumb with determining life insurance for us, and it's a little bit more complicated than this, but just to give you an idea, it's typically 5 times the amount, more closely to 10, of current income, because the number always sounds really high. If somebody makes $50,000 and we tell them they need $500,000, they say $500,000, they'll be rich. But it's not when you look at it as it's meant to replace income and hopefully pay down some debt to avoid a bad situation. So now again, the discrepancy between employer provided or getting it on your own, if we're saying typically you need minimally 5 but more closer to 10 times, if a company is offering 1 times, or for New York State 3 times, really about 2 times after tax, we're significantly less than we need. So a result of lacking or inadequate coverage, averaging 3 times your salary like we're talking about, and it could be significant to many surviving families. So many people feel that they have adequate coverage by simply relying on what they get through work. But again, we've talked about kind of the problem with that. So we talked about an approach to financial protection that sees life insurance as the foundation. Again, when we have clients that they can come in and they can, they want us to do their stock portfolio, they want us to look at their 403B, they want us to help them with an inheritance. Everything always comes back to Mr. and Mrs. Client. This is all well and good, but we have to make sure that insurances are in place so that what we're showing you actually happens, as opposed to hoping things go how we want them to. And so this moves us into our third section, and that's kind of taking the next step and evaluating the needs of, what if one of, you or your spouse passed away tonight, God forbid, would your family manage financially tomorrow, the next month, the next year? Put it this way, it's a question that no one, ever really wants to ask. There's a lot of unexpected things that happen. And a lot of people say, well, I'm young, I'm healthy. Life insurance isn't just for people that get sick. It's also the things that happen that come out of nowhere that we all know horror stories, and it's just making sure that that doesn't affect your family. So your answers to this question outline what life insurance is for. It's for tomorrow, it's for the next month, it's for the next year. Your family's financial needs won't go away anytime soon. And your answers will give you an idea about how much coverage you really need. So remember, the calculations will be different depending on your income, the family responsibilities, how much people have in current assets, how much they have in current life insurance, what their bills are. So every single client that we meet with is completely specific. But for example, you take a case of a stay-at-home parent or a parent who works part-time to allow time for taking care of children. Here the focus shifts a little bit away from income, and now we have to replace the services that are being performed, and this is in quotations, you can't see it, but for free, right? Meaning, because a stay-at-home mother or a stay-at-home father, there is no price tag on that, but it's incredibly expensive to replace that person in the services and the duties that they do every single day. And then there would be, of course, expenses connected with the death. There may be medical bills connected with the final illness, funeral expenses, and then perhaps, estate taxes. But let's concentrate on the living expenses. So with only one income, would your family be able to afford to stay in the present home? Or would they be forced to move to a smaller, less expensive home or apartment? And what we always say is, Mr. and Mrs. Client, listen, this is going to be an incredibly emotionally hard time on the family. There's no reason for it to be a hard financial time on the family. We can avoid that, and so that, with whatever parent is still around or whatnot, let's say, God forbid, there was young children or, middle school, high school children, college kids, you don't have to completely change your lifestyle. What about car payments? Can you continue that? If we don't have the car payments, what about transportation costs? What about, again, if it was a stay-at-home mother or father for a child, now they have to go to daycare. How much does that cost now? What about if the spouse that passed away was the one getting health care? Well, now health care, we have to replace it because the new person that's now the head of the household, you have to hope that you have better health care or equal health care to what you have. And again, something as huge as childcare or, housekeeping and things like that. And so again, all the questions of, what about your family's long-term goals? Could they still be funded? So I would say this is the main thing that gets overlooked. So all along, yes, okay, maybe we're able to pay our bills, but what about the deposits, or what about the, actively savings into the investment accounts like 403Bs, Roth IRAs? What about continuing to save into 529 plans for children? If you think back to an earlier slide, if surviving spouses, are sometimes going to make significantly less money than the two of them combined, right? But what about also if, God forbid, that happens and we don't have adequate coverage, are we now even dipping into retirement accounts? So now you're dipping into retirement accounts and putting yourself in a worse situation for the future, in addition to not being able to save the same amount and the same frequency that you were before. With life insurance, that's a choice that your family may possibly not have to make, and it doesn't cost a fortune for us to protect them. So much of what we talk about or have talked about is of, someone passing away a little bit early, God forbid. And I know this is kind of, a pretty bleak topic on a Friday, so I drew the short straw with being the one that had to do this presentation. But, this also applies to a case of disability. So a serious accident or a long illness, leaving you or your spouse unable to work, it also takes away from a family's income for a long period of time or permanently. The family's expenses may even increase because of medical bills. And as with the issue of someone passing away early, many people believe it'll never happen to them. So again, what we always talk about is if you or your spouse got sick or were injured today and unable to work for a long time, you're just meant to ask yourself these questions. How would your family manage? Is tomorrow okay? Well, what about next month? What about next year? And again, these statistics also are bleak, right? The three statistics given you, it shows when you stop to really think about it, we all know people who have been in car accidents or taken a bad fall or had cancer or a heart attack. It doesn't have to be something as drastic as that. What about bad backs? I mean, back problems can be the cause of disability for people under 45, and it's incredibly common. So the fact is that there's all kinds of accidents or illnesses or injuries that can happen. And these days, they're all more likely to put you on the sidelines, disability, rather than kill you, pass away. So if you depend on a paycheck, being unable to work for a length of time can mean serious financial problems for the family. So there's many misconceptions about disability income. One of them is you think that you're all set because your job provides disability income insurance. Again, employer-provided coverage, which is something that the state doesn't do as good of a job benefit-wise as all the other great benefits that you have. Generally, it's going to cover 50 to 60% of a salary, but it's completely taxable because the company's offering it. So remember, just the easy way to think about that with insurance, same thing with life insurance as I talked about earlier. If a company pays for it, it's taxable. The benefit's taxable then when you get it. If you pay for it individually through someone like us or a different, that shop it out through different companies, the benefit will be tax-free because you're using after-tax money to buy it. So like, workers' comp, for instance, only covers injuries that occurred on the job or illness that results from the job. So that leaves out most illnesses and injuries that happen. As for Social Security, which all you need is one person that you know of that have gone through this process, I mean, the program turns down more than half the applications submitted, and that's based on, statistics from 2010. From statistics of 2012, the average monthly payment was $1,100 a month. So, people complain about the expense of individual disability and coverage, but you can budget that, unlike being able to budget for the now significantly less amount of income or no income coming into the household. So it can be well worth the cost when you consider the amount of income lost during a lengthy illness, or injury or something like that. And so again, proceeds from disability insurance, it'll help your family through a tough time. So now we come to long-term care, which is a very, very hot topic, especially in this day and age. So the question on the slide, it may be a little bit more dramatic, right? So how would you pay for long-term care services if they become necessary for yourself or your spouse? The need for long-term care generally comes later in life when children are grown up and the spouses are older, generally retired. Of course, certainly, debilitating illnesses and injuries can happen at a young age. But the situation most commonly involves seniors who, as we all know, are living much longer these days, which is why this is a much bigger topic than it ever has been, especially because of the baby boom generation. Long-term care insurance is really the main thing I would say people seek out us or financial advisors for nowadays. So higher standards of living and better nutrition, along with medical treatment and new medications, mean that people live with conditions that used to cause death. So before we get into what we mean by long-term care, some of you may be a bit younger or, young enough to not really be thinking about this for yourselves, but you may have concerns about your parents, or you may already have assumed some financial responsibility for them, or see the process that they're going through with spending down assets and things like that. There's actually a name for that, and it means that you're a member of the sandwich generation, caring for both your children and your parents at the same time, so not an ideal sandwich. If not now, you may find yourself in that situation a little bit later on. So again, what services are included in long-term care? So sometimes, right, people help them with shopping, cleaning, preparing meals, home health care, adult daycare, assisted living facilities, hospice care, really towards the end, or nursing homes. And when it comes to long-term care, a lot of the time people get long-term care for specific reasons. For instance, my parents have long-term care, A, because their son's a financial advisor, right? But two, because they said, I'll never go into a nursing home. I never want to be forced into a nursing home. So they buy long-term care so that they will have the money to have around-the-clock nursing care in their home up until something like a hospice would be needed. So the need sometimes is to protect all of your assets. Yes, it's not to be a burden on the next generation below you, but a lot of the time it can be specific so that you say, hey, no matter what happens or down the road when it does, I want to be taken care of. And so what are the chances that you'll need long-term care? People age 65 will face at least a 40% lifetime risk of entering a nursing home sometime during their lifetime. Again, the numbers have really only gotten worse than that now. And we keep this slide that you can see now, we keep this old for a reason. So this is as of 2015. By the way, the average in New York State is more expensive than the national average. Shocker, right? But the national average for a private nursing home room, and that doesn't mean the Ritz-Carlton of rooms. That's the average room. So a lot of those places aren't necessarily where you would want to end up, but the number was, it's a little bit cut off there, the number was 50,000. That was 2015. Now that number, the average one, is at about 62,500. That's just with the inflation on top of, that 3 years ago. New York State's even higher. And again, if you want to be somewhere nice, as crazy as it sounds, it's $100,000 a year. And if we know, right, that the average length of stay, which also has increased, by the way, because life expectancies have increased over the last 3 years, the average stay is 3.5 years for women. So 3.5 years for women at whatever you want to use, the 65,000 for a lower end place or 100,000 for a nicer place. It eats up all of your assets incredibly quick. And so what about government assistance, right? Medicare does provide nursing home coverage for a limited number of days, generally about 90, but only following a hospitalization, which, remember this because I'll come back to it. Medicaid will pay for nursing homes, but only after you have met strict eligibility requirements. So what I talked about with Medicare, so this is just, again, take it for what it's worth. They say that as long as it's following a hospitalization. So if somebody goes from a hospital to a nursing home, Medicare will pay for the first 90 days. Typically, when we sell long-term care insurance, there's a 90-day exclusion, meaning that would have to come out of pocket, and then the policy will go in force. Well, as long as you go from a hospital to a facility, we know that Medicare will pay the first 90 days, and then your long-term care insurance will pay the rest of the time. If you go directly to a nursing home from home, you have to come up with the 90 days out of pocket. So again, not telling people what to do, but if, again, just to say it, if you go from a hospital to nursing home, 90 days are covered. If you go from home to nursing home, they're not. So again, it's just something to plan. And then again, Medicaid is when you spend down all the assets, and that's when you hear people talking about protecting their assets and things like that. And so why do we need long-term care insurance? Honestly, just to give you my personal opinion, after, you know, I've been here 11 years doing financial advising, there's nothing worse than watching the clients that have saved and done every single thing that they needed to do correctly to have a great retirement, and then to leave their children and their grandchildren all the assets that they worked very hard for, go to a nursing home and spend it down in a nursing home so that then Medicaid can put them in a bad nursing home. It's just a really, really bad thing. So, you know, the biggest threat to your retirement savings, it's not when the market goes down, it's not paying taxes or inflation, you know, it's having to spend it down and pay whatever, call it $100,000 a year for 3 years, while the other spouse is trying to live at home. And so, you know, we went over a ton of material, and I'm sorry that I was talking very fast. It's just a lot of slides to fit into the time frame, and I know that it's a Friday, so we want to get you out of here. So just a quick summary: protecting your most valuable assets, which is your income, planning with life insurance, and the disability and long-term care that's out there. So, you know, we'll wrap up in a second. As Michelle had said, there's some Q&A, so I just wanted to thank everybody for taking the time to sit with us. And if anyone has a question, I'd be happy to answer it. If it's a more specific question, though, that could be email or a call if somebody wants to get that information from me, because again, this is all very specific. And that's it, Michelle.
Okay. Do we have any questions? Just type that into your questions panel and we'll go over that. I'm not seeing any right now. I'll give anyone a few minutes to type their question in. And again, this is going to be archived on saneys.org. And that's also where you'll find a list of AXA advisors, so you can contact the person in your area or contact Matt with questions. But all of those resources are online as well. Matt, I'm not seeing any particular questions, so maybe we'll just leave it to follow up. Oh, well, here's a very good question. What is Matt's email?
That's a very easy one. It's my name, Matthew, Matthew, Rizzo, Rizzo, and that's at AXA, A as in Apple, X as in X-ray, A as in Apple, hyphen advisors, ADVISORS.com.
All right. Anything else?
That was a real easy question. I'll take softballs like that one on a Friday.
Yeah, right. Yeah, the answer right away. Okay, well, with that, we're going to log off. And thank you very much, Matt, and happy weekend to everyone. Bye-bye.
Perfect. Thanks.